Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding Podcast, sitting alongside my co-founder, Mr. Geoffrey Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going well. My face is not by the mic. It is going well. Thank you so much. So in today's video, we are going to be going over how businesses can grow using other people's money and why that's good for shareholders.
Yes.
And we have a bunch of different topics to go over. I'm going to bet that this is the only podcast that's ever been done on this topic. I'm throwing it out there.
Okay.
I'm throwing it out there. So
right,
if you like that and you like the work we're doing here, be sure to hit that subscribe button, thumbs this video up, and leave us a rating and review. That helps spread the word. Mm-hmm. Every time somebody leaves a rating and review, I check it often. It warms my heart.
Good.
So 5 stars. If not, please don't leave one.
All right.
All right. So let's talk about AUM.
Okay.
And we don't even need to really relate it to us because, obviously we're in the investing business, but let's talk about other businesses. We've been, doing a lot of work on Truxton. Yeah. Truxton Trust, and they have an asset management part to their business with about $1 billion under management. It's a bank in Nashville. So AUM, as a way to grow using other people's money.
Correct.
What are your thoughts on that?
Yeah. So, I mean, the advantages of it are that here we're talking about not having to put up shareholder money to do these things. So once you bring in money, you can take a relatively small fee. In the case of that company, it's usually around 1% or so of the assets under management. And then if those assets grow over time at a rate that's as high as GDP or higher, potentially, depending on what they're invested in, then you're going to continue to make higher and higher revenue based on that for yourself. And it's a way of doing it without having to put in a lot more money that way. The assets will obviously grow faster relative to the number of people working at your company, to the number of branches that you have, to those sorts of things that are the actual expenses and the actual tying up of your own shareholders' capital. Yeah. So that's the advantage that you have.
And really, this is all sort of, a way of float, I guess you could say.
Yeah.
The way you could think about it. Like, I know the definition of float is like an insurance company, or we talked about deferred revenue and stuff like that, but it's kind of just using other people's money, looking for businesses where they have this source of float, I guess you could say, where they're using other people's money to really grow their business.
Yeah, the easiest way to look at it is just, do investors in mutual funds or whatever, grow their assets as quickly as the companies themselves grow their earnings. Often the case in, growth phases of those industries is no. Yeah. The companies that manage it actually grow it faster because they don't have to put in that additional money for it.
Sure.
They bring in new clients, and that's on top of what they already have. As long as they're retaining the clients that they have, they're going to be able to make more money off of that. And they can do it with a relatively small fee, like we talked about when you have very large amounts of money that way. Yeah. So it's very possible that way. Whereas for each individual client, it's a small percentage of the money, and they're likely to keep it with them, and then you enjoy economies of scale from that. Sure.
Let's talk about float. And obviously, float's sort of this buzzword in the investment industry.
Yeah,
popularized probably by Buffett, right? He's written a lot about the topic,
Mm-hmm.
and I've tweeted out many times documents where Buffett. It's almost like I compiled a bunch of documents that Buffett has written about, and it's pretty cool because you could just control F through there and just type in like float, for example, and you can read everything he's ever written about float.
Yeah.
So it's pretty interesting. So check out my Twitter to get access to that at Focus Compound. But float, how do you typically think about float?
Yeah, so with Buffett, I think about Geico, which you learned about in the 50s. And that it generated float, and that it can make investments and get investment returns on them on policyholder money, basically. Yeah. Before it pays out. So there's this lag of time between when policyholders are paying premiums and then when payments are made for losses. But also things like blue chip stamps. He invested in a company that had stamps that could be used to redeem things, and that would take a time where people saved the stamps and held on to them, and sometimes they'd be in drawers or whatever, and they wouldn't use them. But also just that they would be there until they actually spent them. And with modern day companies, what you see a lot of that little form of float that for like retail related things is gift cards, right? So they have a little float from gift cards where you have the where people purchase the gift cards before they actually end up using them and start redeeming them, right?
Do you think and talking about NACO, do you look at, since they don't actually put up the capital for the unconsolidated mines, but they technically own the mine, right?
Correct, yes.
Do you think about that as like a way afloat? Because the returns on capital are basically infinite because they didn't have to put up any capital.
Yes, that's exactly what I mean. So that's a great example because I wouldn't necessarily call it like float. That wouldn't be normally how we talk about it.
The definition of like an insurance industry, it's not float, but it's a way to look for companies situations like that.
Yes, it's the exact same advantage because we can see that they have a consolidated mine.
Yeah.
And I think the returns are very low there. They don't break out the returns, but I've said before I wouldn't be shocked if they were to tell us that they earn 6% on that.
On the consolidated mine.
On the consolidated mine.
But the unconsolidated ones are like 100%.
Right, because they don't put the capital. But I'm just saying how bad the business can be. And you can also see just coal miners in general, how much debt they have on them. And that's because they need to have that much debt to fund mines. I mean, there's a ton of capital expenditure that you have.
Yeah, and full disclosure, we obviously understand that it's not a form of like float with insurance. All we're saying is to look for businesses where you have situations like this, where they're able to, I guess, enjoy the profitability from an asset or something that they didn't have to actually finance themselves or pay for themselves.
That's what you need is because, I mean, the reason why most businesses grow at the rates that they do is because they have to put a lot of money back into the business instead of paying it out to you in dividends. Using the example of NACO on those unconsolidated mines, you can see that 100% of earnings of those unconsolidated mines are paid out to the parent company, to NACO. Whereas, obviously, in an unconsolidated mine, they have to spend a lot. I mean, I think they're going to spend $20 million or something this year probably on buying up land and equipment and stuff to expand the mine that's consolidated. They have to put that capital up. And I think they've sort of said, we won't do that again. And I think there's a good reason for not doing it again.
Let's go to the banking industry.
Yeah.
Bank deposits.
Yep.
And you had said that obviously deposits per share is one of the most important metrics that you look for when you're analyzing a bank.
Yeah.
So why is that?
Because that's the entire earnings engine for what's going to drive earnings for the shareholder.
Yeah.
So basically, you own a share in the business, and all the earnings that you're going to get eventually are from deposits, which are going to be used to fund some sort of asset, which will either be loans or will be securities that the bank will buy. And then the income off of that is what you'll earn as a shareholder. So you need you need to see the bank growing deposits, but you need to see them growing deposits per share is the really key number for you. So yeah, I mean, I've talked before about banking. We did a whole thing about banking. I focus entirely really on the deposit side and how high quality that is and how low cost it is, and basically looking at it as float. Instead of thinking a lot about whether they can lend that money at some higher rate or whatever. If you just have very, very good deposits, very cheap deposits, very stable deposits, then you can invest in the same sort of things that anyone else can, and you can earn much higher returns than they can because you're not using your own money. I mean, we don't own bonds, and many people listen to this don't own bonds because they're too low returning. But if you didn't put up the money to buy the bonds, someone else gave you the money.
Wonderful.
Then suddenly it's a business model that makes sense, and banks are doing it where, I mean, banks.
But even when you say it like that, it probably puts a little bit more perspective on it for people, right?
Yeah. Well, I mean, so banks have some non-interest expense, which is very significant. We've talked about that. So, like, they have to rent the place, and then they have to do all of that, and it's very big. And I talked a little bit about how that's a problem in Europe, for instance, where no matter how low rates can go negative. It doesn't matter. You still have those non-interest expenses that don't go any lower. You're not cutting the bank's rent when you're cutting, overnight rates for lending. But other than that, what they're doing is they're basically taking 10% of shareholder money, their money, and 90% depositor money, and that's how they're going out to buy a bond. So they're paying 10 cents of their own money for it and using 90 cents of other people's money for it. And that's the whole idea of the business. Now you have to get that other 90% at a cheap rate or else it doesn't make sense. But as long as there's a spread on that other 90%, then you can be very successful. Yeah.
Cool. What about customer prepayments?
Yeah, well, customer prepayments, I did a podcast recently.
Which is a form of float, I guess you could say, in itself.
Yeah, so I did a podcast, DIY Investing.
Yep.
Yeah, and I talked about Necker on that one, and that's a Norwegian company that we own, and it has customer prepayments. And actually, this is a big issue with people deciding how much actual net cash they have and arguing about it, because not all the cash is earned. Some of the cash is prepayments for things that projects that might not be finished for, in some cases, it could be 3 or 4 years.
So it's in the form of like a backlog.
It's a significant backlog. Yeah, they have a significant backlog of 3 or 4 years. But it's huge because it allows you to earn very high returns on capital. Obviously, if you didn't have that, then you'd have to finance things yourself. But it just completely changes the business. And that was what I was kind of talking about on that podcast, which is that, he was asking, Is it a good business? It's cyclical and all this. And really what I was saying is it's just critical that their customers prepay for it. Without that, it would be a very different business. And frankly, we probably wouldn't have bought it if it wasn't for the customer prepayments. Mm-hmm. Yeah.
And that's kind of, I guess, the common theme in a lot of companies that we focus on is sort of, I mean, you take NACO, for example, where they're not actually putting up the capital to build the mines or whatever, but they're able to actually, they technically own it. But then in the same situation with Necker, where they're not, where they have a huge backlog of prepayments from their customers and stuff like that, they could use to finance their business.
Yeah, I mean, sometimes I have a difficulty explaining like my style or what's particular about it or something. But I would say probably what we do more than anyone else is focus on situations like that, like float. Definitely situations where companies don't have to put up their own capital. Mm-hmm. I'd say this idea of other people's money. That's probably the thing that we focus on more than anyone else, I would guess. Mm-hmm. Yeah.
No, I think that's great. So I guess we just did customer prepayments. We could talk about deferred revenue, which I guess is along the same lines.
Yeah. So deferred revenue, the classic examples are like subscription type things, but you see it in technology companies, Microsoft and stuff all the time.
So if you ever see deferred revenue on the current liabilities, it's a form of float.
Yes, it's a form of float.
So that customer paid up, or I guess you could say paid in advance
Correct.
For something.
Yeah, they paid in advance for some service that's provided. In many cases, the service that's provided could be something like a subscription, even if it's a print subscription or a journal subscription or something, even back when those things were all done in hard copy and stuff like that. That's still relatively cheap, actual providing of it. It usually has very high fixed costs, and then just adding one subscriber doesn't cost much. So not only is it a form of getting the money ahead of time, but you're getting the money ahead of time, and there's very little expense that has to be done throughout the year, right? So, like I gave the example of Microsoft or something, licensing some more copies of an operating system or of Office or whatever doesn't really cost them much of anything.
Yeah.
So, a good example of that is we own OTC Markets, and they have a significant amount of deferred revenue from being paid in advance for services they provide. And for the most part, those services would cost exactly the same, whether there were 95 people using it, 100 people using it, 500 people using it. I mean, there's some sales stuff that's very different in getting it originally, but it doesn't really matter how many people are on the platform for how much it costs them,
Accounts payable?
Yeah, so
and we did just go over this. Go watch our past video if you haven't on the balance sheet, where we went over a lot of these line items and talked a little bit more in depth about them. We're referring to Apple when we're speaking about this, but so accounts payable.
So accounts payable is really important. So this is where we talk about like the net working capital cycle and all that stuff. Yeah. So this sometimes gives you some indication of the company's business model when we talk about things like receivables, inventory, accounts payable, accrued expenses, and also sort of their at times their position, their bargaining power, basically. Because the thing is, everyone would like to be paid as fast as possible,
sure, yeah,
and to pay as slowly as possible,
yeah, sure.
And if
it's kind of like Amazon, for example, right?
Yeah, exactly. And if they don't do that,
because you pay up front and then they don't have to pay their I guess, what do you say, vendors or
fast?
Yeah. Sure.
And so that creates a situation where you can have very low margins and still make a lot of money because your margins are low, but your turns are incredibly fast. The example people always give in the past was Dell, where basically it was like paying for things after it had already collected the money for it. It was paying for the parts that you were getting basically after it had after you'd already ordered it and paid for it. Which is a hugely different business than what was before then, which is like actually putting together a computer, putting it in a store. That was what it was before then. So usually it shows some bargaining power that the company has, and that's important. And a lack of it, that you can't pay slowly, does indicate sometimes that you don't have a lot of bargaining power. We talked about this in, I think I talked about it in the podcast on Omnicom. I know it's in the Omnicom report. It's a big issue in advertising, because advertising has a situation where they have float of a few weeks basically. So they're they're collecting payments from customers before they're paying for the purchases that they make on behalf of the customers. So that's huge because usually most companies are doing this on their own behalf, right? So they have a little bit of float from doing this with the working capital cycle But in the case of an agency, they're doing it in a huge amount because they're doing it on behalf of another customer. And then what they're left with is just a small fraction of that, right? Their commission. So it's sort of like if you imagine a realtor or something, right? Imagine if you were like actually paying the realtor for a house or something, you know what I mean? And there was a spread between the time when they collected money from you for the house and then when they gave it to the other person for it. That would be pretty good business for them, right? And that's part of the idea for advertising agencies. And there was some push by big advertisers, big brands, to do away with that, basically to be able to pay slower. And when that happened in one case, which we talked about in the report, like 4 of the 5 biggest ad agency holding companies in the world just didn't show up to pitch for the idea or anything, even though it was $1 billion account or whatever. So, the idea being that they were saying, look, we're not your bank and we're not going to finance you. But what they really want is for you to finance them. That's part of the business model. It's always been the business model, and that's what they need to make it successful. Without that, advertising would be an advertising agency would be a lot less attractive business.
When you think of businesses where they're sort of self-financed by their customers, what comes to mind? What type of businesses? Other than banks?
Sure. I mean, anything with subscription is going to be that way, but some things with backlogs, like we talked about. So especially things like that also don't. The other issue we haven't talked about much is this is just getting the financing of getting other people's money, but it's also an issue of how much money you need. So the best case is when you have a lot of other people's money and you're in an industry where there's very little need for capital.
Sure, yeah.
So that's why something like asset management business or a software business or an engineering business works really well. If you have the same thing in a cement business, it wouldn't matter as much because there's still so much need for capital. NACCO's a really weird example because there's so much need for it in mining, but the accounting there is really complicated because what they're really doing is they're just contracting for them to do it for them, but because the way the accounting works, it looks like the customer is putting up all this money, right? Because technically they're the one who owns it, the contract miner. But I think that in general, you need things where so engineering is a good example, but I'm saying that it's not just because they have backlog, because shipyards have significant backlog where sometimes people will actually pay them in advance. It doesn't help that much because it's so asset intensive that they usually still have really low returns, even when they have a significant amount of prepayments or something. It just doesn't help.
Got it. What about deferred tax liabilities?
Well, so this is like Buffett, right? This is the idea of, he says that's one break that you get is that the government is basically loaning you money in a sense that you don't have to pay the taxes until you sell, right? And that used to matter a lot more to Berkshire when corporate tax rates were a lot higher and, all those sorts of things. I was on a podcast, DIY Investing, where I talked about that, about turnover and stuff. And I said, certainly there's harm in having 100% turnover, and there's probably a lot of harm in having 50% turnover. I wasn't so sure.
What type of turnover? What are you talking
your
about?
shares.
Got it.
So selling your shares, your stock that you have.
Oh, so you're speaking about the shares outstanding.
Yeah. No. If you're investing money, so like Berkshire investing money, an individual listening to this investing money,
the turnover in the portfolio,
because it's going to trigger taxes faster. So first of all, obviously, if there's a difference between short-term and long-term capital gains, then that's harmful. And so obviously, you want to time that so that you're making sales in the right way,
efficiency,
in terms of a year and a day or whatever later, and based on what those things are. But so it's almost always going to be a bad idea to sell within a year. Depending on tax treatment in all different countries, this is all different. But the bigger issue is beyond that, what turnover is most helpful? And I said in that podcast, I wasn't sure if I'm not sure at all the turnover below 10% would be helpful because the harm is that you own something that is no longer as attractive. So there's always that trade-off. We did that where we talked about people trying to save money on taxes, not taking not selling something and taking a gain because they don't want to pay the taxes is not a good idea. But for some place like Berkshire that needs to soak up a lot of capital permanently, it's a very smart way of doing it. But you have to invest in things that you plan to be in for the very long term. So that sort of thing that we're talking about is only going to work in cases where it's very good businesses and things like that. And so that's the tax inefficient part of a Ben Graham type strategy.
Yeah, you spoke on that podcast as well, and we'll link to it down in the description, and definitely check it out. It's DIY Investing, and he has a website as well. But you had spoken about how for example, if somebody owns a stock and you're up 100% on it, now they feel like even if they think it's still cheap, they feel like they have to sell some, right?
Yes.
And now the idea should not be to make 100%. The idea should be to go into it to own a business that you feel like you could own for a very long time,
right.
even more than 100% or whatever, you know?
Yeah. And the way to think about it in terms of like the most efficiency is always to think in terms of from this point forward what you expect it to return.
Yeah.
So if you're looking at a stock, I mean, we've sold stocks before. If I sold a stock and it was like, well, I think it's only going to return 5% a year from now on, then it's smart to sell it and take the taxes.
Yeah.
It's not smart to do it if you say it goes up 100% and you're selling something that you think is going to return 15% a year from here. You know?
Well, that's what I'm saying.
Yeah.
I mean, we had obviously asked that a lot about NACO.
Yeah.
So when are you going to sell? It's like, well, it's actually still cheap, but relatively to what you think.
Yeah. So you just have to weigh the idea of taking the tax hit versus the idea of what you expect the future return in it to be. And so usually with a really good business, that allows you to hold it unless it's an absurd price. But even in the case of Warren Buffett, to be honest, he should have sold Coke.
I was going to say, he says
Gillette.
he
should have. He should have. But that's not what he does. But even then, I can go through the math and say, look, he should have sold those things then in the late 90s, right? But it's rare. Other than that, it hasn't happened in many cases. Like he's owned stocks that there was never a point where he had to sell for that reason. Now, early in his career, he would have, though, because you have more ideas than money, and it makes sense to switch into things that have higher and higher returns.
Yeah,
he
was flipping his turnover of the portfolio was a
partnership, he made like 30% a year, and his personal money, he probably made 50% for a few years there. So in those cases, it makes sense to take the tax hit quickly because you're going into something that the returns are so much higher. But you can do the math on that and people can figure it out. Yeah.
Cool. Well, that is the end of today's video. I want to thank everybody so much for tuning in with Mr. Jeffrey and myself. Be sure to check out his Gazette. It's a weekly email that goes out. You will get access to our watch list. There's 10
it's a watch list. So just so everyone knows, it's been changed a little bit. It's a watch list of our stocks, 10 ideas on it, and it also has a little blurb about some of them.
Yeah.
So it's basically stocks that we're looking at. They're all overlooked, and they're things that I might write up in the future. I will write up in the future on the paid site, which you won't get, but you will get the watch list, so you can go.
And there's some people, I mean, for example, when I was listening to your podcast with Trey, and he's not even a member of Focus Compounding, but he looks at all the companies that
are on the list.
He's on the list, and he just goes and does his own due diligence.
Because he asked me about a couple of them. Yeah, one of them.
This company was on number one for like 3 months, and you don't own it.
And I don't own it. That's correct. Yep. Yeah. So listen to that podcast, and you can find out what was that stock that was on the list at the top for a while, and I didn't own it and didn't write it up, but it was on the watch list. Yep.
Yeah. So if to get on that list, go to focuscompoundinggazette.com. If you're watching on YouTube, hit that subscribe button, thumbs this video up. That helps spread the word. I want to thank everybody so much for tuning in with Mr. Geoff and myself, and we will see you in the next podcast.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.